Good evening, students. Just allow me a minute, students. Udeep, Aishwarya, Karthik, good evening to all of you students. All audio video fine? So very quickly, students, brief me about one quick point about your Group 2 paper. One is about the SCMP and the second one, the today's elective paper. Quickly, students. Indrakshi, good evening. So students, about today's paper, SCMP was better. And elective today? Fair enough. So I think students, the Group 2 paper up till so far so good. It can be assumed in this way, and now we are now into the next last two paper of your this group number 2, starting with direct tax. Now the fact that students, you have the ample holidays for the direct tax paper, obviously you will try to also use it for the some of the students have told me that they also want to do or use at the time also for the IDT paper. Fair enough, we can accommodate that as well. So students, here first today's particular point that we are going to discuss in this context would be, first will be starting will be the last one video, students, I have already shared on international taxation. Some portion of international taxation is there to be done. We are going to do it right now, and thereafter students, there would be assessment of companies. That is again an important area of your examination which is going to be there. Apart from that, students, there would be transfer pricing, again a very important topic as far as the examinations are concerned. So what we are going to do is that now we are going to do session by session, and we are going to cover up your topics in this particular manner. Now the PDF, students, which I'm using it, students, I have already shared in my Telegram channel, which is already given in the description box of this particular video. So you can all go through this description box on my video for what? For this PDF, which I'm going to use it for the lecture. Students, I not only intend to do the theoretical part, I also intend to do with all of you the practical portion, because obviously the practical part is equally an important area. Now in the last lecture, students, we were discussing about the international taxation, and I have eventually covered more or less primary important areas as well. Now, but still couple of them, students, are very important for your this examination of November 23. And that is exactly why primarily we will now let us focus on that particular area as well. One topic, students, that you should always keep in mind in this particular context is this taxation of the NRI, non-resident Indian students. Please keep in mind and be very careful on this particular area about the non-resident Indian taxation, the NRI taxation which has been there. Now, so far as NRI taxation, students, is concerned, there are some set of special provisions which are there in the income tax law, which all of you are aware of it. Some special provisions, students, are there in the income tax law, so in the NRI topic. However, just a brief of background is very important for all of you to keep in mind, and which is the fact that this NRI, students, is nothing but a person of Indian origin. Primarily, that is what is the criteria which you should always bear it in mind. Person of Indian origin, students. Now, there could be a possibility of an examination question that could be either in the form of an integrated case study, or it could be in the form of, students, either it could be, as I told you, integrated case study, or it could also be in the form of a practical full-fledged question. Two particular questions could be expected from this side. One is the case of the integrated case studies which are being there, and the second one, students, is in respect of the full-fledged practical questions. Now, in the integrated case study, students, they could tell you about some mother and father example who were born in India and they have left India thereafter, and they have got their some children. They were born abroad, but the children somehow or the other have came to India, say for job purpose or for education purpose, as the case may be. Now, in that case, they are not a citizen of India because they are born outside India, but the fact remains, students, they are person of Indian origin. Okay, they are person of Indian origin. Keep that in mind now. Now, if you are a person of Indian origin, students, just there could be a possibility wherein you have to be very careful on this. They could target a residential status first to all of you, and very smartly then they will tell you to calculate tax liability. So first challenge in the integrated case study which I can see would be, they will try to focus on what? Focus on the residential status of an individual. Shivam, good evening. So let me in fact recall quickly, students, residential status test. More importantly, I will just put across with all of you the important area of the individual residential status test. Please recall, students, with me in this case. Rahul, good evening. Two basic tests are given to you. Let's recap on that. Two basic tests are given to you. The first one is the stay in India in the current previous year should be for minimum 182 days. Minimum 182 days. Stay in India should be for minimum 182 days, and you will consider both the day when he has entered in India and the day when he left India. Both the days has to be counted. That is point number one. The second particular point, students, is in this case that if he does not stay in India for 182 days or above, but his stay in India is for minimum 60 days in the current previous year, and in the last 4 preceding previous year, it is for minimum 365 days in the last 4 preceding previous year. In that case also, he could be a resident. Fine. Now this second basic test of 60 days in the current previous year and in the last 4 preceding previous year, aggregate minimum 365 days. This second basic test will not be applicable. Now, in which case it will not be applicable? It will not be applicable in the case where, point number one, be careful, students. Point number one, a citizen of India who is leaving India for the purpose of taking up the employment, for employment purpose, if he is leaving India, then that citizen of India, for him only the first basic test has to be considered. Manju, good evening. Only the first basic test has to be considered. 182 days. I'm talking only about the citizen of India who is leaving India for what purpose? For the purpose of employment outside India. In that case, only the first basic condition has to be considered. And the second case, where only the first basic condition of 182 days will be applied, will be a citizen of India, now be careful now, or a person of Indian origin. So when he is leaving India for the purpose of employment outside India, in that case he should be a citizen of India for that first basic condition. But in the second case, he could be either a citizen of India or he could be a person of Indian origin, and that citizen of India or a person of Indian origin is coming in India for visit purpose. Coming in India for what purpose, students? Visit purpose. So be careful on this PIO, huh? So PIO, if he is coming for visit purpose, be careful over here. If he is coming for visit purpose, and then thereafter you have to ask this question, that whether the total income, in the question you have to see total income excluding which, what students? Total income excluding the foreign source income, including the foreign source income. So minus the foreign source income, in this case, does it exceed rupees 15 lakhs? That's the question that you need to ask in this regard. Does it exceed rupees 15 lakhs? This is a question that has to be asked. And if your answer is yes, or again if the answer is no, if the answer is no, then nothing done, students. Only the first basic condition has to be considered. Only the first basic condition has to be considered. And what is the first basic condition? The first basic condition is that of 182 days in the current previous year. So the first basic condition of 182 days in the current previous year only has to be applied over here in this regard. But if the answer becomes yes, then he has got the two basic conditions. And which are the two basic conditions which he need to satisfy? One of the two to become a resident. As you all know, 182 days, any case is there already. So any case, I'm not touching upon that. But the second one is an important one. And what is it, students? Indeed. So current previous year, CPY, I'm writing short form, students. Current previous year, he should have a minimum of how much, students? 120 days in the current previous year. All of you agree to this one? Minimum stay in India should be for how much, students? 120 days should be the minimum in this particular context. 120 days in the current previous year, plus what, students, in this context? Plus in the last 4 preceding previous year, 365 days. Exactly, students. So last 4 preceding previous year, students, his stay should be how much? For 365 days. It should be for minimum 365 days. So all of you agree to this one? All of you, students. So therefore, you have to be very careful when you now go in the examination, students. There could be a possibility that this particular person, they will try to give a particular spin in the question. And what is the spin in the question? They will say that, look, this person, his father or his mother, in this case, has born outside India, and he has come for visit purpose. And they will also give you the total of his income as well, and you need to verify if his total income other than the income from foreign source, does it exceed rupees 15 lakhs? If the answer is yes, it does, then check out between the two that whether he's stay in India in the current previous year, is it 182 days or above, or if not, then whether his stay in India in the current previous year is for minimum 120 days, and in the last 4 preceding previous year, his stay in India is for minimum 365 days. If he satisfies one of the basic condition, he becomes a resident. But if he becomes an NRI, means he does not satisfy the basic condition, then his status, students, in this case will be what? If he doesn't satisfy any of the condition, then his status would be NRI. Be careful, huh? His status would be an NRI. And then they will also may ask you a question that now kindly calculate the tax liability. Kindly calculate tax liability as per the provision applicable to NRI under the Income Tax Act. As per the provision or the special provision applicable to the NRI under the Income Tax Act. So now if there is a special provision that we have to check into it, it has to be chapter number 12A. That is precisely what is the chapter number 12A, which we all are there, which we all know are aware of this particular point, students, chapter number 12A. So that is exactly what now we are going to quickly discuss across. So this is the first variety of question which I expect to be in the integrated case studies. Okay, or they could directly target to you what, students? A full-fledged practical question as a 8-mark question for the NRI as per chapter 12A, the special provision of chapter 12A, kindly calculate tax liability. So first, just quickly recap the provision, and then directly I will jump into the practical question which is there in the notes. Now in this context, students, all of you just pay attention. NRI students in this case will have to use his foreign currency, and through the foreign currency he need to make the investment in some specified asset. Now that in a specified asset is what? In this case, securities, as you all know. But as far as the securities are concerned, you have to be very careful on the securities part. And what is that, students, for the securities? Point number one. So far as the securities is concerned, shares are there. It could be of public company, family. It could be of public company, students, or in this case, it could be of private company. Shares, we don't have any issue on this. But they will give you some other things like deposits or debentures. In that particular case, you have to be very careful. The deposits and the debenture, students, has to be of the public company. So just keep that particular point in mind. The deposits or the debentures, that needs to be of a public company. Okay, private company will not serve good. That is not a specified asset. And then they can also give you central government securities, but they have not targeted it. But nevertheless, keep in mind, if they talk about the central government securities, in that case also, that is a specified asset. So if you are using your foreign currency to purchase the specified asset, in that case, the NRI will be eligible for the Chapter 12A provision. Now, what Chapter 12A provision does? It provides you the special rate of tax. And what is the special rate of tax, students? In this case, two income. One is the long-term capital gains. Long-term capital gains is taxed at what rate, students? What is the tax rate for the long-term capital gains? It is 10%. And other than LTCG, the investment income like interest, dividend, for that income, the rate of tax is 20%. Now, in respect of these two income, we all know that there is absolutely no deduction of any expenditure which is given in that regard. No deduction of any expenditure is given, students, in this case, isn't it? But now, very important point, students, that you should be very careful about it. For the in the Chapter 12A, students, when we discuss on this one, LTCG, when we talk about it, be careful. Huh? This LTCG, now recent attempt ICI is targeting, first of all, there is two things. One about, in this case, is about the computation. In the computation part, students, you have to be very careful. Recent attempt ICI is targeting the first proviso to section 48. First proviso to section 48. Now, what is this first proviso to section 48? In this case, the first proviso to section 48 is nothing but the conversion and reconversion of the amount. I hope that all of you are aware of this conversion and reconversion. What is this conversion and reconversion of the amount? So first, what you do, the full value of consideration, whatever is the INR amount given to you in the question, you will convert into foreign currency, for which you will take the average of TT buying rate and the TT selling rate. You take the average. For which date you are going to take this TT buying rate and the selling rate? On the date of transfer. So you take the average, and then whatever is the INR FPC, you divide this INR FPC with the average of the TT buying rate and selling rate, and you get the foreign currency amount. That is the FPC. Expenses on transfer, same average has to be applied and get that expenses on transfer. Then cost of acquisition, same average you will take of TT buying rate and selling rate, but only on the date of purchase of the security. That average, you will divide this amount on that cost of acquisition which is in INR, get that particular cost of acquisition in foreign currency, and that is how you get the capital gains in the foreign currency. Capital gains in the foreign currency. And once you get the capital gains in the foreign currency, you will reconvert it into what? Into the INR. Now that capital gains in foreign currency, how do you reconvert into INR? By applying. Now don't use the average. What you're going to use? The TT buying rate as on the date of transfer of the shares. TT buying rate as on the date of transfer of the share. You will apply that on the capital gains that you have determined in foreign currency, and based on that, students, you will get the capital gains in INR. Based on that, you are going to get the capital gains in INR, and that exactly what you're going to do. I hope that all of you are clear with this one. So you get this capital gains, and that is what this first proviso to section 48 will be all about. Is that clear to all of you, students? Every one of you? Now this is very important, students. ICI, why I'm saying so, 2 attempts back, they have already started targeting this. In one of the question we have seen that this is there. By the way, students, this first provision to section 48 is applicable to non-resident who is using the foreign currency, who is using what? The foreign currency to purchase shares and debentures of Indian company. To purchase what? The shares and debentures of Indian company. So therefore, in the context of, this is the point which is there for first provision to section 48. In the context of the NRI, non-resident Indian, first provision to 48 is very much applicable. Although I must admit before all of you that it is not seen in the old NRI question. The data of first provision to section 48 is not seen in the old question of the ICI. But I already told you, some 2 attempts back, they have used this particular TT buying rate and the selling rate, and that concept has to be considered. I hope that all of you are clear with this one. So please, in chapter 12A only, keep this particular point in mind, because if they will give you the data again of the TT buying rate and the selling rate, you will have to use it and try to get the long-term capital gains computation. Now the second rate, once the computation is done, then the rate of tax will be applied. Now as you know, students, this rate of tax is 10%. Now this 10% is to be applied on the long-term capital gains. 10% is the rate to be applied on the long-term capital gains. Now please don't do this blunder which we used to do in 112A. Please ensure don't apply this 112A concept. In 112A, what we have to do, the long-term capital gains under 112A, students, what we used to do in LTCG or 112A, we used to reduce rupees 1 lakh. We used to reduce rupees 1 lakh. Now are you going to reduce rupees 1 lakh in this particular case? When you have to calculate the LTCG under 112A, on which the 10% rate has to be applied, are you going to reduce this rupees 1 lakh which we used to do in 112A? Answer is no, never. You are not supposed to touch upon this 1 lakh at all in the calculation of chapter 12A. So that chapter 12A, students, whatever is the LTCG that you have computed, simply take 10%, and that will give you the rate of tax on this. They will also give you dividend income. They might also give you interest income from that specified asset. Please tell me, what is the rate of tax in that? Dividend income and interest income, the rate of tax to be applied is 20%. If there is any expenditure that you have earned, if you have any expenditure that you have incurred, if you have incurred any expenditure, students, are you going to reduce that expenditure from this particular, are you going to reduce this particular expenditure from this particular interest income or dividend income? Again, the answer is no. No reduction of the expenditure that you may have incurred against the dividend income and the long-term capital the interest income. Please keep that particular in mind, and whatever is the LTCG that whatever is the investment income that you have earned, on that simply apply 20%. Simply apply 20%. Fine. So that is for the investment income. Now supposingly there could also be a twist in the question, which we are going to do it right now. They may say to you that this NRI does not want to pay the tax on the LTCG. This NRI does not want to pay the tax on the LTCG. Is there any other remedy available? If the NRI does not want to pay the tax on the LTCG, then yes, there is a remedy available, for which what he needs to do, that from the date of transfer, when you have transferred that shares or the securities, from the date of transfer, within 6 months, he need to make the investment in the specified asset. From the date of transfer, within 6 months, he needs to invest in the specified asset. If he does it, he will definitely not be liable for any tax. But if he does not do it, or if there is any shortfall, students, be careful, huh? Shortfall is also important. It may so happen that only 80% of the net sale consideration has been invested. Only 80% of the net sale consideration has been invested. So if only 80% of the net sale consideration has been invested, so your whatever the LTCG that you have computed, only 80% would be exempt. Balance 20% will be taxed at the rate of 10%. Is that point clear to all of you, students? This is exactly what you need to know as far as this particular 12A is concerned. Now, as I told you, students, 2 types of question. First question I already discussed with all of you in the integrated case study, how they will draft the question. That is point number 1. And the point number 2 is this, that we are going to discuss, is a separate independent practical question, a separate independent practical question that they may target where in this particular computation. 8 marks could be the maximum coverage that will be there. So for that purpose, students, I will just quickly run through one practical questions with all of you in this case, so at least that practical is also being taken care of. Now see how the build up is there. This is the old question of the ICI which they have already given to us. So let's quickly run through to this old question of the ICI. The PDF already has been shared, students, so I'm just picked up directly this practical question. Let's have a look over here, students, in this context. So here you go, students, over here in this context. The following data the following data is furnished to Mr. Sumed, a non-resident and a person of Indian origin. Now see how they are giving the question. Non-resident and the person of Indian origin. This will make him as what? This will make him as NRI. Non-resident plus the person of Indian origin will make him as NRI, students. Now let's have a look. Long-term capital asset arising on transfer of foreign exchange asset on 31st July 2022. That is the date of transfer. How much is the LTCG? 6,50,000. Expenditure wholly and exclusively incurred on such transfer. In this case, that LTCG, while we calculate the LTCG, this will be reduced. Interest on deposit held with the private limited company. Now this interest income, students, will be taxed at what rate, students? 20%. Interest on government securities, I already told you, students. No, sorry, hold on, students, over here. Interest on deposit held with the private limited company. Is the private limited company, students? Please tell me over here. Be careful now. Be very careful now how you're supposed to go about it. Is this private limited company? Is it a specified asset? It is about a deposits and what did I told you? Deposit and debenture should be of public company. This they have given you the private limited company. So if they have given you about the private limited company, therefore it is not a specified asset. Chapter 12A, rate will not be applicable. Go to the normal provision now and take what is the rate applicable. Now the rate applicable, many of you may say, sir, it is 115A. That is the rate that is applicable, because for non-resident interest income in 115A, there are two rates which we all know, and we have revised this in the last lecture also. One is that rate is of 5%, another is a rate of 20%. That is the rate. But be careful, even this 20% rate which is there in 115A for the interest income, this 20% demands that the loan or the debt from which the interest income is earned, that loan and the debt should be in foreign currency. Only then the interest income will be charged under 115A at the rate of 20%. Whereas in this particular case, be careful, this is about the deposits which are held with the private limited companies. Now deposit or debenture, if an Indian company is issuing, now this is an examination note, deposit or debentures, if the Indian companies are issuing, then in that particular case, students, what we are going to say? If the deposit or the debenture, if the Indian company is issuing, safely you make an assumption in the question. What is the assumption that you can make in the question? That it is assumed that such deposits and such debentures are issued by the Indian company in INR. And if it is issued by the Indian company in INR, which means that the debt is in INR, and if the debt is in INR, in that particular case, whether 115A rate will that be applicable? And the answer is no. If the 115A rate is also not applicable, then where he will go? He will then go with the normal rate, not the special rate of 115A, and the normal rate would be the slab rate. The normal rate, students, would be what? The slab rate. So it's a slab rate is what then now you will have to take into account for this interest income, which would be now will be taxed at the normal rate, which is, as I told you, is nothing but the slab rate. Is that point clear to all of you, students? Fine. And that exactly is the point, students, which is to be considered over here. I hope that every one of you are clear with this particular proposition. No doubt on this particular part. So, and please make an assumption. And the assumption is that we are assuming that the deposit and the debentures which is issued by the Indian company to the non-resident are issued in INR. And because it is issued in INR, therefore the special rate of 115A is also not applicable. Which means that the slab rate is what has been considered for the purpose of determining the taxability of the interest income. Now on that particular note, students, if you see further over here, Interest on government securities 95,000. Interest on deposit with the public limited company 2,60,000 rupees. Now, as far as public limited company is concerned and the government securities are concerned, are they the specified asset? Answer is yes. So can we say for the government securities and the public limited companies, can we use the 20% rate which is applicable in chapter 12A? For the government securities and the deposit with public limited company, can I go with that 20% rate? And the answer is yes. What about the dividend from domestic company, students? So far the dividend from domestic companies are concerned, we will definitely go with the 20% rate, because there we don't see shares, whether it is a public company or whether it is a private company. For shares we are not bothered in chapter 12A. Simply put, this also 75,000 also you can take at 20%. Now let's have a look to point number B, saving and investments. Now, investment in notified saving certificates referred to in section 10(4)(b) on 30th of March 2023. Now, please be careful. The investment, students, is in the notified saving certificates. And when he is making the investment, what is the date of investment? 30th of March 2023. When did he transfer that shares? When did he transfer the shares? On 31st of July 2022. So, yes, he is making the investment in the specified asset. Okay, but did he make the investment in the specified asset within 6 months from the date of transfer? Answer is no. He didn't make the investment within 6 months from the date of transfer, and therefore the exemption under section 115F is not applicable, which we discussed just now, and hence will be there? This exemption not applicable. Even the second one, the second investment, students, is much later on 31st December 2023. 31st December 2023, here also the exemption of 115F is not applicable. TDS. Now, students, sometimes TDS should be kept in mind, students, over here. Why TDS should be kept in mind? Because they may ask you a question. See here, compute the balance tax payable. Balance tax payable, this is what it is. And when it is a balance tax payable, tell me where the TDS has to be shown in this context. TDS has to be shown, students, on the final tax liability. Be careful, this is a silly mistake that people do it. Not before the HEC, it is after the HEC that the TDS has to be considered over here. I hope that all of you are clear with this one. And then thereafter, students, the refund is due of this much amount. Now, if it is possible for all of you, please do make a mention in the examination that to get the return, to get the refund, the NRI will have to file the return of income. Why? Because for the refund, there is only one route to obtain the refund. For the refund, students, there is only one route. And what is the route? File the ROI. This is one observation that you can keep it in mind as far as the questions are concerned. Rest of the things which I have already discussed with all of you, students, LTCG, and thereafter the expenditure on the LTCG is to be reduced. Fine. Thereafter, students, the investment made will not qualify for the exemption. The investment made will not be qualifying for exemption. Why? Because it is made after 6 months. After 6 months, students, in this particular context, and that's the reason of this one. Thereafter, students, the investment income which is there, government securities, deposit, be careful, students. Deposit, be careful on this one. In this case, sorry, deposit with public company, it is fine. So this 95,000, 2,60,000, 75,000, absolutely fine, no issues on that. We will apply what, students? We will apply chapter 12A. We will apply chapter 12A, students, in this case, in this context. What about the deposit with the private limited company? 5,90,000. Deposit with the private limited company. What did I told you, students? What did I told you? I told you that deposit with the private limited company, students, you will have to go with what? Indeed. In this context. Which rate, students? Which rate? Yes, exactly, students. So that's the rate that will be applicable in this context. The normal rate will be applicable over here. So the normal rate, students, is what will be applicable over here, and that is what you have to keep in mind. Perfect, students. So normal slab rate is what will be applicable, and that is what. Piyush, Indrakshi, perfect. So I hope that all of you are clear. So that if you see the tax liability calculation, 20%, students, 20%, Karthik, 20% is applied on 4,30,000. Can you see this? 4,30,000. These are from the specified asset, and whereas 10% is applied on the long-term capital gains. 10% is applied on the long-term capital gains after minusing the expenditure on transfer. So 57,000. And balance, what is the balance? Balance is this 5,90,000 only. This balance is 5,90,000 only, is on the slab rate. Then one question can come in mind that, sir, when we apply the slab rate, shall we go with this 115 BAC slab rate, or shall I go with the normal slab rate? Students, if 115, I should tell to all of you that 115 BAC, the alternate tax regime applicable for individual, is also applicable for a non-resident individual. All of you agree to this one? The 115 BAC, the special regime, the special tax, alternate tax regime applicable to individual is equally applicable to a non-resident individual. So yes, it is equally applicable to NRI. But in the examination, students, what you should do is that unless they specify 115 BAC, you should not go with that rate. The slab rate should be the normal slab rate. But in the note, you please do write that while calculating the slab rate, the alternate tax regime rate of 115 BAC is ignored. Please do make a mention of it. Or you can assume that this NRI is assumed not to have opted for what? For 115 BAC rate. For 115 BAC rate. But there could be another trick in the question. Please read the question very, very carefully, students. The question reading is the most important point. If they tell you calculate the tax payable refund due to maximize what? His savings, or to minimize his tax liability. If that is what is the wording that they are using it, then you all know, students, if I have to minimize his tax liability, then I have to look into the savings part, because you also are aware that when we apply 115 BAC, the start rate starts from 5%, then it goes to 10% in this case, then 50, like that it keeps moving only 5% till it hits 20% at 15 lakhs, and then beyond 15 lakhs it goes to 30%. So if that is the case, the question is drafted in such a way that they are asking you what should be the approach to minimize his tax liability. At that point of time, you can say that it is assumed that to minimize his tax liability, this NRI has opted for what? Opted for 115 BAC. I hope that various permutation combination you are clear and be aware of it on the examination day, students, because that's precisely what you will be getting it. But if this language is missing in the question, minimizing the tax liability kind of language is missing, then what are you going to do in that case? Apply the normal slab rate and do write a note. What is the note? It is assume that he has not opted for 115 BAC. Is that point clear to all of you, students? Every one of you are clear with this one. So this is what, students, is the case which has been there. Now then, students, I am approaching to all of you to this special rate for the FII, foreign foreign institutional investor, students. Last lecture, students, I have already did with this with all of you ADR and GDR. Last lecture we already did ADR and GDR. So therefore, let's move to FII, and then one quick question I have to do before we start hitting to the foreign tax credit, before we start taking the foreign tax credit in this regard. Now, students, as far as this is concerned, students, let's please have a look, students. FII, foreign institutional investor, students, one of the attempt they have targeted a practical question way back. After that, what I have seen is that ICI came up with their case studies. In that case study also, this was there. There is no rocket science in this. Only one thing has to be remembered, students, and that is this. You just need to remember the tax rates. That's the only thing that is required to solve the question of a tax liability computation for the FII. Only the rate is to be known. So therefore, there is as such no great stuff which is there in FII question. Students, just get fearful of the FII. Students, just remember this section number 115 AD. Sometimes they may say you calculate the tax for this company as per 115 AD. This is also a possibility. If they may not tell you FII, they may refer what? 115 AD. In that case also, you should know that this is the rate of tax that is being applicable. Is that clear to all of you, students? Let's quickly run through this particular rate. One specified fund, just forget this particular part. In this case, just look upon to this one, dividend. I'm just skipping the specified fund. You can also skip it. Primarily in your examination, they will not target on this particular frontier. Just keep this particular pile. So specified fund, I'm just skipping it now. Now just look upon what is the FII rate. Now just one way to remember it is this. Think of it, be very careful. Students, this is the way you should remember this. Just recall first what is the normal rate applicable to a non-resident for these incomes. If a non-resident would have earned these incomes, then what would have been the normal rate? That is what the first and the foremost thing you should always try to recall. Dividend income, for example, if a non-resident earns a dividend income from an Indian company, then in that particular case the rate of tax is a special rate under 115A and the rate is 20%. Here also it remains 20%, no change. Fine. If the non-resident has earned interest income, then please recall students, what is the rate that you have learnt in 115A? Two rates I told you. Which are those two rates? One is at 5% rate in 115A and the second one is a 20% rate in 115A. 5% rate and the second one is 20% rate in 115A. So 5% and 20% are the two rates. Here also the rate will remain the same. So please relax on these income of FII. Which income? The income which is interest income, dividend income. These two income, you just go with what has been given to you in 115A. Where the things will change, it will change in STCG and LTCG. This is where the trick is. But first recall STCG. FII, we all know they are going to invest in the securities. And mainly students, the security would be those, mainly I'm talking about it, there could be an exception, but please be careful. Mainly they are going to invest in the security which are listed in a recognized stock exchange on which STT is paid. Listed where? In a recognized stock exchange on which STT is paid. So if it is an STCG which is arising on transfer of a security listed in recognized stock exchange on which STT is paid, on that what is the rate applicable normally? 111A. The rate we all know, 15%. Here also 15% is the rate. Rate remain the same. Okay. Now what about the other? Is there any other special rate? Is there any other special rate for the STCG? Answer is no. So therefore this is what you need to remember, and what is to be remembered is 30%. So if it is not that STCG which goes under 111A, then in that case the STCG rate to be considered would be 30%. That is what only needs to be remembered for FII. So just remember 111A. If the question does not have the 111A criteria, what is the criteria? Transfer in a recognized stock exchange on which STT is paid. If that is not mentioned, then you will take on the STCG 30% rate. Fine students. And if it is an LTCG, then first be careful, check out if there is an applicability of 112A. If there is what? Applicability of 112A for the LTCG. And what is that LTCG applicability for 112A? Transfer in a recognized stock exchange on which STT is paid. Again the same thing which has been there. So if that is the case, then 112A will be made applicable. And if it is 112A which is made applicable, then you are also aware of the fact that that 1 lakh, there is a exemption which is given on the LTCG which is determined. That LTCG which is to be determined is without any indexation. It is also without any conversion and reconversion. Please don't do conversion and reconversion here. In this case, first proviso and second proviso are not applicable. So no conversion and reconversion would be undertaken over here. Is that clear to all of you? So simply put, whatever is the LTCG, on that LTCG apply 10% after reducing 1 lakh rupees. Fine, that is a rate. But other than that of 112A, like unlisted shares, if that is what has been transferred, then that LTCG again will not be having any indexation. It will also not have any conversion and reconversion. First proviso, second proviso to 48 is not applicable. So simply put, calculate the LTCG normally, full value of consideration, cost of acquisition, whatever is LTCG. Now it is not 112A, isn't it? So no 1 lakh will be reduced, isn't it? And therefore that LTCG that you have computed, on that applied 10%. So the rate remained the same. Be careful, students. The rate remains the same. However, what changes over here in this case is the fact that 1 lakh exemption will not be applied in this context. I hope that all of you are clear with this one. Only remember this much. As far as FII is concerned, please do remember 115 AD also. 115 AD also. Is that point clear to all of you students? With that, we are done with this FII particular part. Now students, one question I will just, last lecture we discussed this question. This question already was done. Question number 5 in the last lecture. So can I deal with the next question, students? One question I just need to deal with you, and one important point I just wanted to share with all of you students, just confusion about the grossing up of TDS. Many students have got this confusion. Sir, in which question are we supposed to do this grossing up of TDS? And that is one of the common query that many students have asked in this case. So let's try to look upon to your examination approach. I think Vioni question number 5 we discussed in the last lecture, so I'm not touching upon it right now, but I'm going to use that particular Vioni question very soon in this case. Please have a look to this question, Trex Limited. Again, these are expected questions which I consider to be there in your examination. Let's pray for the best. Trex Limited, a company incorporated in country T, has the following income in India during the year ended this thing. Now they have given you something about the poem. I am going to quickly revise the poem also, so therefore I have used this particular questions as an opportunity to revise even the poem test. Poem students, for a foreign company, frankly speaking, they will not ask you a dedicated question. That is my take. Because poem, when it was a new provision, at that time they have asked this particular question. Right now they will not ask you. You just try to revise the provision itself. So if you can take across that particular page, students, all of you are in that page of poem. All of you, please flip up your page of poem. I give you 30 seconds time. Quickly, students. In the meantime, students, I'll just take my charger. In the meantime, you'll just open up the poem. We'll discuss quickly because my phone battery is getting down. I just need to see this, your chat. So I'll just take a charger. All good, students. So let's look upon to this now quickly. So I'm discussing with all of you students now the poem part. Poem students, for a foreign company, but just be careful. They may not ask you this question, but nevertheless, let's not take a chance. They may tell you one important feature on the poem part, which is this. If they tell you the turnover of the foreign company in the previous year has not gone more than 50 crores, this many students are not aware of it. If the turnover of the foreign company is not more than 50 crores in the previous year, in that case, students, the poem concept is not applicable. Then you have to go with the old provision. And as per the old provision, the foreign company is considered as a resident in India if 100% control and management of that foreign company is situated in India. 100% of the control and management of that foreign company is situated in India. What did I told you? Check the turnover of that foreign company if they have given you in the question. If they have not given you, they are trying to tell you go with the poem concept to decide whether the foreign company is a resident in India or not. Okay, but if they have not given you anything in the question, then definitely I told you poem. Now, as far as the poem is concerned, How do you decide that the foreign company is a resident in India? For that purpose, the poem of that foreign company should be situated in India. The poem of that foreign company should be situated in India. Now, in that case, for that purpose, we need to check first is the active business outside India test. Two boxes are there. One box is for active business and another is for outside India. When a foreign company's business is considered as active, when the foreign company's business is considered as active, if its passive income does not exceed 50% of the total income. If its passive income does not exceed 50% of total income. Now be careful, students. When you have to talk about the passive income, you have to consider everything. When you talk about a passive income, like they will give you that this foreign company has got interest income, dividend income from India, from Sri Lanka, from France. So please understand, you have to add all the passive income, whether it is earned in India or it is earned outside India. Add all the passive income. Okay, so you will add all the passive income. Passive income is other than business income, which means capital gains, royalty, FTS, interest, dividend, rent. All these are the passive income. But as far as the interest is concerned, be careful. If it is a banking company, then the interest is the business income. If it is a banking company, then the interest is the business income. Students, just keep one point in mind. On interest income, there is a thin capitalization also. In transfer pricing 94B, you all are aware. And in that, you have learned that supposingly a non-resident AE has given a loan to its Indian AE. Okay, and the Indian AE is paying the interest of more than 1 crore. Then you apply 94B. But be careful in that. If that non-resident AE, if it is in the banking business, in that particular case, students, what we are going to say? In that case, 94B will not be applicable. So in that situation, students, 94B will not be applicable, students. 94B will not be applicable. So just keep that particular point in mind. If it is a banking company which has given the loan to its Indian AE, in that particular case, but 94B will not apply. So this is a minute thing which you just keep in mind, because they will ask you, and they have this particular tendency to ask you these things just to test you whether you are aware of these points or not. Anyway, the passive income which I was telling to all of you will consist of all these elements other than business income. One item of business income is to be considered as a part of passive income. One item of business income is to be considered as a part of passive income. And what is that? When the purchase of the goods has been made from the AE and the same good has been sold to another AE, then whatever is the income arising from this transaction would be a part of the passive income, both the purchase as well as the sale. That both has to be there. Okay, then the income will also be part of the passive income. So if the total of all the passive income does not cross the threshold of 50%, it is not more than 50% of the total income, in that case the business of the foreign company is active. And when it is considered outside India, when the following test is less than 50% in India. Following test is less than 50% in India. And which are those following test, students? The asset test is less than 50% in India. The number of employee test is less than 50% in India. Now here it's the India specific data is what you're supposed to consider. India specific data is what you're supposed to consider in this case. And the last one, students, is the payroll given to those Indian employee. It should be less than 50%. Now here will lie some important calculations. And what are the calculations? Asset test. Now in the asset test, students, you will take up the average of opening WDV and the closing WDV. You take the average of it. Opening WDV and the closing WDV, please take the average of it. If they go to that extent that you will have to calculate the average, by giving you the data of 1st April 2022 and 31st March 2023. If that data is what has been given to you, then you have to take the average. Now this is only for the depreciable asset. For the non-depreciable asset, you will take up the book value. Book value, which would be that value for tax purpose, that is point number 1. Or the second one, if they don't follow the tax in their home country, then you take up whatever is the value given to you in the question. What about the employee test? In the employee test, there is one important point. And what is that? If some of the employees who are in the payroll of third party, but they are working for the foreign company in India, some of the employees are in the payroll of third party, but they are working for the foreign company in India, then even that particular employee will be considered as an employee in India. Even that employee will be considered as an employee in India, and accordingly whatever is a payroll which has been given to even these employees would be considered. So both the number of employees including this portion of employee should be less than 50%, and the payroll given to these employees should also be less than 50% in India. If this all the condition is satisfied, then we will say that the foreign company satisfies the active business outside India test. The foreign company satisfied what, students? The active business outside India test. And then you will say that the poem is presumed to be in where? If they satisfy the active business outside India test, the poem is presumed to be outside India, provided one condition, that majority of board meetings are held outside India. Presuming what, students? The majority of the board meetings are held outside India. Is that clear to all of you? However, in this case also, there could be some sentence in the question that they will say you that the de facto control of this foreign company who satisfies the active business outside India test and has majority of board meeting held outside India, but the de facto decision making authority is in India, or a resident in India, or an Indian company. In that case, the poem of that foreign company will then be considered to be in India. The poem of that particular foreign company will be considered to be in India. Is that particular point clear to all of you? Next, if the foreign company does not satisfy the active business outside India test, if the foreign company does not satisfy the active business outside India test, then in that situation, students, you have to go with this two aspect very carefully. Which are those two aspects? Point number 1, you need to check who is the person who is taking the key managerial and commercial decision for that foreign company. Who is that person who is taking the key managerial and the commercial decision of that foreign company? And the second one is where that decision is taken. And if that where happens to be in India, then the poem of this foreign company, which foreign company? The foreign company which does not satisfy the active business outside India test, that poem will be considered to be in India, because that where is in India. What is that where? The key managerial commercial decision is taken by that person who is taking this decision in India. I hope that all of you are clear with this one. Okay, now be careful. Now, irrelevant data is what ICI is giving it to you in the question, like the way they have given you in this question also. Irrelevant data. What are the irrelevant data? Irrelevant data are like the foreign company is a 100% subsidiary of an Indian company. Does that make its poem to be situated in India? No. If foreign company is a 100% subsidiary of an Indian company, does it means that the poem of that foreign company is in India? No, this is not the test. Similarly, shareholders, not board meeting, shareholders are doing the meetings in India. Shareholders are doing the meetings in India. Will that make the poem of the foreign company in India? No. Shareholders are not for the management of the company. They are only having what? They are only having the voting powers. They don't have the management of the company. So you cannot say that the poem of this foreign company whose shareholders are meeting in India, therefore the poem is in India. Never do that, because this is what they have done it in this question. This question of the important question for your examination. So Trex Limited company incorporated in country T has the following income in India during the year ended 31st March 2023. And what is that income? Compute the total income and tax liability of Trex Limited for AY 23-24, assuming that its poem is outside India. Fine. So no, not this question. There was some other question where I think that was Vioni INC dot in the last lecture that we discussed. Vioni INC dot in that last lecture that we discussed, students. And what was that? In that question, the shareholder meeting was given in India. Because the shareholders are meeting in India, does that make the poem of that foreign company in India? Answer is no. Let's see what are the data that has been given to us. Interest of rupees 2,85,000. Now be careful, students. The word that has been used is earned. Okay, interest of 2,85,000 earned on debentures of 30 lakhs issued on 1st of August 2022. In consideration, now this debenture is issued in consideration of providing technical know-how to MNO Limited. In consideration to provide what? To provide the technical know-how to MNO Limited, which is an Indian company, for the purpose of business carried out in India. For the purpose of what? Business which is carried out in India. So there are two incomes over here, students. Be careful. One is the FTS income, which is of 30 lakhs, and another is the interest income. One is the FTS income, and another, students, is the interest income. So there are two income which are there. So as far as the FTS income is concerned, in this case 115A is what we will apply. You remember 115A FTS is what is the rate? So what is the rate of 115A in this case? For FTS income, 10%. Same is also for royalty, 10%. But only one condition that you have to be careful. What is that condition? Condition is that the foreign company should not have a P in India, and through that P it is not providing these services in India. Because if that happens, a foreign company is having P in India, and through that P they are providing services in India. In that scenario, students, you will say what? Say that gone. What is that? 44DA will be then made applicable. 44DA will be then made applicable, isn't it? But here in this question, I know that information is not there. So in that case, 115A will be applied for the FTS income. Okay, so 30 lakhs is the FTS income. On that, 115A rate is 10%. But on that debenture, which is the consideration for the technical service, on that debentures, interest income is also earned. Now, if interest income is also earned out of that debenture issued, please tell me whether this interest income, will it be charged to that 115A rate of 20%? Whether this interest income which is earned out of the debentures issued by the Indian company, will that be charged to that 115A 20% rate in the previous particular case study what I told you? Answer is no. Debenture and deposits which are issued by the Indian company, you will always write they are issued in INR, and because they are issued in INR, therefore the applicable rate would be the normal rate. Now here it is a Trex Limited, so Trex Limited is a company, so the normal rate would be 40%. In the NRI question that we discussed, in that it was a individual, so we applied the slab rate. So this 2,85,000 will go at 40%, whereas 30 lakhs, which is the normal rate applicable to a foreign company, whereas 30 lakhs will go at the rate of 10%. Okay, that is point number one. But here lies one word which is earned. Just I'm telling you what is the difference, how to read the question. Dividend of 6,50,000 earned on JDR. Last lecture we discussed about the interest income and the dividend income from JDR. Interest income and the dividend income earned from the JDR. What is the rate of tax? Is there a special rate of tax on interest income and dividend income earned out of the ADR and GDR? Yes, and the rate is 115AC. 10% is a special rate. 10% is a special rate, students, and because 10% is a special rate, accordingly on the dividend income of 6,50,000, you will apply 10% on this. Please apply 10% on this one. Coming to the next one, so therefore 6,50,000 into 10%. Is that point clear to all of you, students? So that is what would be the rate. Dividend of 15,50,000 earned on equity shares of Indian companies. Again, please see a word is earned on equity shares of Indian company. So this dividend 115A rate 20%. Foreign company is earning a dividend income from an Indian company. Special rate of 115A will be applicable. 20% is the rate. Point number 4. Income by way of royalty amounting to rupees 12,56,470 received from Z Limited. Now suddenly the word has been received over here from Z Limited, an Indian company, in pursuance of an agreement approved by the central government. Now because everywhere it is earned and suddenly here it is received, then that changes the equation of our calculation. What is that? We will see, but let's see point number 5. Business income of 8,50,000 from a unit established at Delhi. Business income. So business income of a foreign company, 40% rate. Point number 6, LTCG of 1,32,000 on transfer of unlisted shares of an Indian company computed with the indexation benefit. If computed without indexation benefit, the long-term capital gains would be 2,32,000. Now there is a presentation confusion which has been there. I must tell you, in fact I have told you already in the lectures also, a foreign company primarily, if they are earning, students, be careful students over here, a foreign company which are earning, which has transfer a long-term capital asset which is unlisted securities, unlisted security, then please tell me students, what is the scenario over here? Foreign company has transferred LTCA. They have transferred what? LTCA, and that is of unlisted security. Then we apply 10%. Rate is a 10%. Is a rate. Now no indexation would be given in this regard. No indexation benefit is to be given in this regard. So without indexation, just take 10%. That is the rate of tax in this case. That is the point, friends. Okay, so therefore just keep that, but this particular point in mind. So computed without indexation, so therefore at 2,32,000 you will apply 10% without indexation. That is what you have to take into account, friends. Yes, Ashwara. So this is what you will have to deal with it. Now notes are given, no DTAA exists. And second point, the unit in Delhi is not involved in any manner in provision of technical know-how or royalty. Why this is important? Because if they are involved in the provision of technical know-how, then that FTS income will go under 44DA and not under 115A. Then that FTS income will go under 44DA and not under 115A. That is the point. Now over here, the tax liability, students, I have already discussed with all of you. Just the only factor over here therefore is, so there is a business income of 8,50,000, FTS of 30 lakhs. Now see the royalty income, if you can see over here, they have done a gross up. The royalty income which has been there over here, in this case is 12,56,470. Now they have done a gross up of this amount. Now how they have done the gross up of this amount, students, be careful. Supposingly if your payee, who is a payee? In this case, the payee, students, in this case is a foreign company. Foreign company or a non-resident, if they are the payee, they are the receiver. Okay, then the payer in India, they will have to then have to deduct the TDS, and that TDS that they deduct, students, the TDS that they will deduct will be after loading the HEC of 4%. The TDS Nidhi that they are going to deduct, that will be after loading the HEC of 4%. So that will be the effective rate of TDS. So if you see over here carefully, in this case, royalty income, if you see 10%, but it will be 10.4. The TDS that the Indian company is going to deduct would be at 10.4. And after deducting TDS, he is going to receive. So how much he has received? He has received 89.6. So if he has received 89.6 and 89.6 is 12,56,470. 89.6 is 12,56,470. Then how much is 100%? Because in the total income we have to show 100%. So how much is 100%? Do the cross multiplication and your 100% happens to be 14,02,310. 14,02,310 is your 100% of the amount. Okay, that is what it is. I hope that all of you are clear with this one. And the rest of it, students, is the same. Income from other sources, interest on this one, and tax liability, students, I have discussed already with all of you. Business income would be at 40%. FTS again. FTS, students, just this is 10%. This is the correction for FTS is at 10% only. This is error which has been rectified. FTS would be at 10% because in this particular context, the reference of this approved from the agreement has not been given. This is an error from the ICI particular this thing which has been rectified subsequently by them. This information about the approved and not has not been given. So please try to ignore this particular 40% which they have done, and therefore FTS would be at 10%, which is at 3 lakh rupees. Okay, so 3 lakh 40 and 3 lakhs royalty income under 115A. But that royalty income would be on the gross amount. The gross amount is 14,02,317, which you already have calculated it, and that is a 10% is the rate which has been there. Long-term capital gains would be on 2,32,000. I already told you, students, without indexation, 10% rate is what would be applicable. So therefore, that is the LTCG. Interest income on debentures. Why debentures? Which is already issued in INR, students. Debentures are already issued in INR. and because the debentures are issued in INR, the rate applicable will not be 115A rate. The rate applicable will not be 115A rate. It will be the rate at 40%. It will be the rate at 40%, and that is the rate. Dividend on GDR at 10%. Dividend on GDR at 10% would be 65,000, and the dividend on Indian company, not the GDR, that will be 20% rate. I already discussed with all of you. So this is the normal particular calculation which has been there. Now, one last information which I just told you, students, please have the habit of doing the grossing up to nearest 10. Please have the habit of doing the grossing up to nearest 10. That is one thing that you should always keep in mind so far as your examinations are concerned. Do the grossing up to nearest 10, and that is what you would do it. Now, one important point, students. In Vioni, in the next question, this is where the main confusion lies to the students. Sir, why we don't do gross up in the other particular case? So if you see in Vioni case also, the last lecture we discussed this question on Vioni, and over here if you see the second adjustment, students, over here in this context, fees for technical service received 4,54,000. Similarly, point number 3, interest received from MNO unit located in IFSC. How much is that? 15,400. Okay, and let's see the other two data. Apart from these other two data, first data is dividend declared by Miani INC dot. That is point number 1. And point number 4, the next data, on 26th of August, Vioni sold the equity shares. They have sold the equity shares. That is the fourth data. Fine, students. Now, accordingly, students, the final point that is there for with all of you in this case is this. The final point, students, which is there in this particular context is this. Students, be careful. In this, many students will argue, sir, here why we have not done grossing up? You would have got the idea by now. In this question, the grossing up was not done in those point number 2 and point number 3 for FTS and interest, even though it is received. Even though it is received, still the grossing up was not been done, students. Why is it so? The reason was they are now making a comparison in the solution where if the question has got these two terms, which two terms? If you have seen in the previous question of Trex Limited, they are using the word earned. Dividend also earned. Consistently everything earned. Dividend earned. And suddenly what? Royalty received. So in the question when the word consistently uses earned, and then there is something which is received. So earned means the entire amount. And received would means what? After deducting the TDS. Whereas in the next question, it was only received. Earned was not there. Only dividend declared was given, that is it. Declared in that particular scenario. Okay, but they have used in the next question of Vioni INC dot, the word which has been used is only received consistently. So now the catch is like this. If at all in the question, you find that they are giving you earned and then they are giving you received also in the same question, then in that question, you will do the gross up of interest. Make an assumption also, assuming that here it is received, so it is assumed that it is after deducting TDS. This assumption needs to be made in the question, students, and then you will do the grossing up. In which question I am talking about it? In the question where both earned as well as received has been mentioned. But just like the next Vioni, in that there were only received, earned was not there. Hence, no grossing up is done. But still, though you will not do grossing up in that question, but still what you are going to do? You will still write a note. What is the note? We are assuming that this amount received is the gross amount and not the net amount. Is what? Is the gross amount and not the net amount. This note has to be given to you in this context in any of this thing. I hope that all of you are clear with this one. That in this question, the word consistently used is earned and suddenly you are getting received in between. That's where the grossing up is done. but where they have not used the word earned, and then the question only talks about received. So what is the assumption you will make? That it is assumed that this received is the gross amount and not the net amount. Okay, you also need to be smart, students. Don't start doing this grossing up primarily in those questions of Vioni antidote. It is not wrong. Answer is right still. If you make an assumption, what is the assumption? It is assumed that this received is net of TDS. Still the answer is right because you have done the gross up and you have written a note. But you will waste a lot of time in a DT paper, the paper which is lengthy. I hope that all of you are clear with this particular point, students. Fine. So therefore, this is the scenario that you should always bear it in mind. And with that, students, we are done with this particular thing completely. And now we are good to go with the foreign tax credit. So students, let's march ahead to the FTC, the foreign tax credit. Now this is an important area. Every item this question comes, there is no option but, students. Allow me 2 minutes. All of you, if you have sharing your notes, you can just go through that in this case. And just also take across the practical question, students. In the FTC particular question, just keep that practical besides you. I'll be discussing those practicals with all of you. In the FTC question, keep that page ready. Just allow me 2 minutes. Double taxation theory also, I'll just quickly revise this particular case. There are two in this double taxation. There is when you talk about double taxation, so there are two types of double taxation, friends. This is a theory which is popularly asked. Double taxation. And what is that? Economic double taxation, and another one is a juridical double taxation. Economic and juridical, and the juridical double taxation. Now juridical double taxation happens when the income is juridical double taxation. When it happens, always start your answer writing theory with this one, not with this one, because I understand that many of you will goof up